Hey, what's up, guys? It's Hans from Remnant Finance. Today, we're going to talk about the average rate of return and why it's a fallacy. You might be asking, how is something that we can mathematically prove out, use that to project into the future, but it is a very faulty way of applying that data point. It's more than useless. It's deceptive, and I will show you why. Key question, can you use historical average returns to project future returns? If you go on any online planning software, website, etc., this is exclusively the method used. And if you can find one that doesn't use this, please let me know. I've tried and I haven't come up with anything that doesn't rely on this fallacy. This is not a valid data point. And here's why. I'm going to start with an article from RamseySolutions.com. It's one of Dave Ramsey's website. Can you really get a 12% return on your investments? And so they talk about how the market goes up, the market goes down, but on average over this time period, the market returned X%. That's how the conversation always goes. All right. So in this case, where does the idea of a 12% return come from? Well, they cite the S&P 500 and they take a selection from 1993 to 2022 in this specific article. And they say that that's a pretty reasonable bet for your long-term investments. Now, in our world, our paradigm of how we view capital and finance, using the word bet when we're talking about our one single shot at getting to that desired pot of money, which is how the financial model typically goes. You put in yourself into risk assets in order to grow to a certain number that you can live off of. You get one shot at that. You hit 65 and you're not there. You're going back to work, right? We don't want to see the word bet anywhere in our strategy at all. That off the bat tells me that we're not on the same page here. But when you click on that link for long-term investments, it shows this beautiful mountain of growth. We start with $100,000 in this case, and I put it out for 30 years. I used 11.13%, and you'll see how I got that number in the next chart. But you'll see that 3 decades from now, we're looking at about $2.5 million. That's a very comforting number, and that might convince you to go into the funds that he's getting paid to put you into. Okay, so what I did was I took the same 30-year window, 1993 to 2022, that they use in that article. I used the market returns of the S&P 500, and if you want to double check my work here, I cited at the bottom the page, and that is a footnote link from the article. So everything I'm doing here is organic to the article that I'm citing. You sum up those 30 returns and divide it by 30, and you do indeed get 11.13%. And here's what actually happened to your money over that time period. You started with $100,000. By 30 years, it grew to $1.5 million. You take the 1 year's balance, and then once you have the next year's return, you apply that to the previous balance and so on until you get to year 30. Now you see some down years in here. You see 2008, we took a 36% haircut. We continue to compound on the previous year's balance until we get to our final number of $1.5 million. So that's our actual compounding return. If you would put $100,000 in the market in that time frame, that would be your return. However, here's where the deception happens. And this is where there's two paths that you can take as far as how you interpret this data. And again, this path that I'm going to lay out here isn't mathematically incorrect. It's just not good planning. What they do is they say, because 11.13 was the average, we can apply that to every year in the market. So we forget what actually happened, and we do the same math. We get our average, and you can see every year we apply to the previous year's balance 11.13% growth. Well, that looks great. We never have a down year. That gets us $2.4 million. We had $1.5 million in real life, but using these projection models, we had $2.4 million. So the Ramsey return, $2.4 million, is a difference of $824,000. You were 35% short on that projection. And if you were retiring in 2022, let's say, and your plan was based on having $2.4 million, being 65% of the way there is not going to cut it. Now, just recognize that these numbers here show in the middle column with perfect information what happened. And so you could think of that middle column as history, and you could think of that third column as the future if you were to use those numbers. If you sat down in 1993 and projected out with perfect information, you knew without a doubt that the next 30 years the market would average 11.13%, and you use that tactic, you would correctly flow that out to $2.4 million return if you believed that every year you would get that average rate of return, if that average rate of return meant anything. But of course it doesn't, because in the actual experience of the market with perfect hindsight, we know you fell 35% short. So that strategy relies on several faulty assumptions. It assumes no down years in the market. You saw that every year was a positive 11% growth. That doesn't happen. A down year wrecks the entire trajectory of this compounding growth. No taxes, no fees. Now, those are two things that I'm going to cover in more detail in the next section because you're specifically told not to worry about minor petty things like that. It also assumes that you don't do any of the common human behavior involved in the market. Over 30 years, you're never withdrawing. You're never trying to time the market. You never buy high, sell low. You never have FOMO. You never dip your toe in, DC, all these things that are common in the market. You don't do any of that. You just perfectly compound for 3 decades. And here's a graph of what we actually end up with. And you can see when the negative years are factored in, what that does to your principal. This is a very simple example. I'm going to drive it down to a very basic level so that you can mechanically walk through exactly how this deception works. This is a 4-year made up return, exaggerated for effect. Year 1, we start our $100 with a 100% return. Year 2, we take a 50% haircut. So we doubled our money, then we lost half of it. Year 3, we doubled it again, 100% return. We're up to 200 again, and then we lose 50%. After those 4 years, we are back to 100. We've made $0. Yet, if you apply the average rate of return, you would do the same thing we did before. You would sum up those 4 years, divide by 4, and you would find that you have an average rate of return of 25%. And so what does the projection software show you? It shows you that you would have $244. So you would have had a return of 144. That's 140% growth on your money. And so we know what actually happened, but we also know that if we knew with foresight that we'd have a 25% rate of return, we would expect 244. That's a very exaggerated example just to show you the disparity here, but you can select any 4 numbers. And as long as there's a negative number in there, I have yet to find a combination of numbers where the average does not drastically outperform the reality. You can take any 30-year selection of the S&P 500 and the average rate of return projected out is going to outperform greatly the actual return during that time period. I've tried it with every 30-year selection, but you can test it yourself if you'd like. So the article continues, and this is where it really gets, I would say, irresponsible to sugarcoat it. Some financial experts want to nitpick over a couple percentage points on a rate of return and fees. Get real, they say. Don't let some goober blogging from his mother's basement or your broke brother-in-law with an opinion keep you from investing. Look at the facts, gather up all the numbers. All right, let's gather up the numbers. What we're going to do now is we're going to jump to the Leap calculator, which is a financial strategy and planning software that has very robust future calculators that we can use. And we're going to see exactly what happens when we do nitpick a couple percentage points on a rate of return and fees. And we're going to realize that not nitpicking those is highly irresponsible. And for instance, you'll see a 3% change in your rate of return from our 11.13 down to 8% is going to cost you over $1 million on this return. So we'll go there next. All right, here we are in the Leap software where you have really robust calculators. So you can actually nitpick at this, as they say not to do. I put $100,000 over 30 years and I put 11.13% rate of return, just like we calculated there. And we end up with $2.37 million. The difference between what I showed in the spreadsheet versus this could be due to when beginning of year, end of year, when you compound it, etc. We can change those up here, but for the purposes of this, we're very close to what we projected there. The first thing he said was, don't let somebody nitpick over a couple percent rate of return. Well, let's just see what happens if we change this by 1%. We're going to drop it to 10%. 2.3 million becomes $1.7 million. That's $600,000, and that's just a percent, 1.13% difference. So yeah, nitpick that. Let's drop it again to something maybe more realistic, which I still don't buy based on the premise that we're talking about here. But let's say 8%. You're at $1 million. You lost $1.3 million, and that's a difference of 3%. So yes, nitpick a couple percent if this is the way you're planning for your future. Like if it's going to cost you more than half of your projected money. If the strategy you're going with, you better be nitpicking. Now, I'm going to jump back up to the 11.13 that we're using before, and we're back up to our $2.3 million, right? Now, I'm going to turn on historical rates to see what actually happened. Now, again, we're switching from the Ramsey mode of average rate of return to compounding mode, the actual, what actually happened over that time frame. I turn on historic rates, and I started in the same year, 1993, and look where we are at, $1.58 million. So by turning on historical rates and seeing what actually happened and jumping away from the average rate of return method to the compounding method, we see that we took that same haircut, 30 to 35% that we showed on the presentation, right? But now we're not supposed to nitpick rate of return. We're also not supposed to nitpick fees, but let's just see what happens with the fee. And we'll call, 1% is pretty standard in a mutual fund, and Ramsey's huge on mutual funds. So if I do the 1%, 3%, we'll see that we go from our actual returns of 1.58 million to 1.17. That's a huge impact from 1%. In fact, over a 30-year span, a 1% management fee, because that loses its compounding value as well, is typically going to eat up about 30% of your income, which we can see here. But let's be conservative. We'll call it 0.5. And a lot of people do ETFs and have really low funds, really low fees, but there's back-end fees, front-end fees. There's different ways to bake the fee into the cost. And so in total, a 0.5%, we can consider that a pretty conservative, and it still costs us a couple $100,000 in this case. Now, this is assuming no taxes. Another thing we're not supposed to nitpick, but if we pay taxes out of this account, i.e., let's say 22%, because again, we're projecting ourselves to have $2 million. Let's say we have a pretty standard distribution here and we are in the 22% tax bracket. So I'm going to apply that. If this account pays the taxes, even crediting for losses, we drop down to $646,000. So yes, you need to be nitpicking if this is the method you're going with. Do not just rely on the average rate of return to solve all your problems. All right, so here we are back at the article. We showed how a 1% difference in the rate of return would cost you hundreds of thousands of dollars in this projection. We showed how a 3% difference in the rate of return would cost you over $1 million, more than half of your projected wealth. Look at the facts, gather up all the numbers, the article says, which if you look at the tag at the bottom, the snippet for it is the 12 reality. Well, we just demonstrated that reality was actually myth. So the idea that you're not going to, quote, nitpick, that you're not going to get into the weeds and dig in and try to figure out what impact these things will have on your projected growth, i.e. rate of return, fees, taxes, etc. That is such a preposterous position to take and such horrific financial advice that imagine if the 30-year selection that we had projected yielded an 8% rate of return. Well, we just saw how much that damage that would do to our projected earnings. And so leaving your wealth and your one shot at getting to the life that you want, if you're doing this model of delayed gratification and accumulating and building up and then finally having enough to retire with, if you're doing that model, you better find an expert who wants to nitpick this, or you are doing yourself a great disservice. It's unbelievable that this is considered acceptable financial advice, yet it is. Just to sum up a couple key takeaways of what we learned here. Using the simple average will give you faulty projections. It's very easy to see now, and this idea is what initially caused the scales to fall from my eyes and realize that maybe I had been tricked in how I was looking at my financial planning and my strategy moving into the future that I was hoping I would get. If you show exclusively positive returns, you're going to give a fantastic but unrealistic prediction of what's going to happen into the future. The big foot stomper here is that historical performance, not only can it not be reliably used to predict the future, it's irresponsible to do so, but it cannot even reflect the past from which those numbers derive. So it is totally useless as a data point in your financial plan. There should be nowhere in your financial plan where the average rate of return from a past segment of the market is ever considered. If those words are in your financial strategy, you are being misled. So any negative years include in a market segment are going to halt that rate of return. You need the uninterrupted positive compounding growth in order to get a way to accurately project into the future. And that brings us to the product that we use for the infinite banking concept, which is the only financial vehicle where you can find guaranteed compounding growth for life. I will take a guaranteed compounding 5% growth over an average rate of 8 or 9 or 10% because I know what actually happens when the down years and what they can do to your principal. And I don't want to take a chance of going through a inevitable downturn because we are in a boom and bust cycle and we seem to be rapidly approaching the bust phase. Who knows when that'll happen, but what that can do to our principal when we don't have guarantees in our contract, i.e. we don't even have a contract at all, we're using speculation, can be very harmful. So again, to summarize, if you see the words average rate of return in your financial strategy anywhere, you should be asking why your advisor thinks that's a valid data point to use. It is not. Please reach out with any questions, hit us up. I hope that helps, and thanks for watching.